In this, our final discussion about stocks, we'll take a look at some all-stars of investing and then a few final odds and ends. Because I always feel if you want to learn to do something well, take a look at the people who are doing it well, who have done it well. Study them and steal from the best. And here we have some of the best money managers of the last 50, 100 years. I call them the all-stars of investing. Peter Lynch. He was the fund manager for the famous Fidelity Magellan Mutual Fund. And he wrote a wonderful book called One Up on Wall Street that we really push the students in BUS121 to read. It's extremely enjoyable. He writes with a great sense of dry humor and self-deprecation. And so I think you'd really enjoy it. One Up on Wall Street. He tells you to buy what you know. Look, if you understand the business model for Nike or Federal Express and you use their products, maybe you want to invest in them. Maybe you don't. You have to do a lot more research. But he says, don't go looking for companies where you have no idea what they're doing, and just because somebody said, this is the newest, greatest, latest thing, and good luck with that. Warren Buffett is widely known in the press these days as a grandfatherly figure, but don't let him fool you. He's a very astute and competitive investor. He says, look, don't buy the stock, buy the company. Huh? Well, you can't buy Nike, folks. It's tens of billions of dollars. But if you were going to buy Nike because you had those and you thought that was a great company to own, or Home Depot, or IBM, or I'm not trying to pick on those companies, but if you would want to buy all of Apple and you had the $1 trillion you needed to do that, great. If you don't have the $1 trillion, go ahead and buy 10 shares or 5 shares or whatever you can afford. You understand? He puts the emphasis on the value of the entire company. And then if you can't afford to buy the entire company, and of course we can't, then go ahead and buy whatever you can afford in the form of shares. Benjamin Graham was Warren Buffett's teacher, and he is often called the father of value investing. He wrote a book called The Intelligent Investor. Now, don't go out and read that book first. No. Read One Up on Wall Street or A Random Walk Down Wall Street before you read The Intelligent Investor. But eventually, if you are serious about investing, take BUS121, but you're going to want to read the Intelligent Investor eventually. John Templeton, Sir John Templeton, pretty good for a kid from Kentucky, was one of the first mutual fund managers to go outside the United States and invest globally. And we'll return to him in a bit. He was a very, his website and his legacy live on because he always was interested in merging the world of finance and investments with the spiritual world. In other words, this is great, this is Caesar, right? But how do we introduce the kingdom of God, through Christianity, into it? In other words, how do we fulfill people's spiritual needs, not only their financial needs? And so his website and his legacy live on. For slide 49, Bill Miller. Now, Bill Miller is an interesting case. He set a standard that probably will never be broken. Kind of reminds me of the outfielder for the Padres, Tony Gwynn, who won the batting championship 7 times. I mean, no one's going to do that again, right? And so he, as the fund manager of Legg Mason Value Trust, for 15 calendar years in a row, beat the S&P 500. And because of this, of course, he became the financial media's megastar, which for me, I think is unfortunate for him. Because how do you work when people are looking over your shoulder with a 10,000-watt spotlight like the media does? But then what happened is he started doing badly in 2006 and then 2007 and 2008. He started to redeem himself in 2009, but then was just destroyed in 2010 and 11. And they allowed him to retire in 2012. Now, I'm surprised they didn't kick him out of there before that, because it's a tough business. But Mr. Miller's still around, and he's gotten into a few other things. And so if you're interested, you can follow him along. So it's a tough business. Here he was at the top of the world, and then because he didn't do very well for a few years, then boom, he's kicked out. What do all these people have in common on slide 50? Well, they have courage to not follow the crowd, because the conventional wisdom is usually not very wise. And they have an eye, what I like to call almost a sixth sense. They have an eye for unrecognized value. Everybody sees this, but you or this person, or if you're that person, sees something else and says, no, you don't understand. Look at this over here. And Gary Kasparov and Anatoly Karpov are an interesting pair. They were the two best chess players in the world, and one would win the championship, and then the next year the other one would win the championship. They went back and forth until eventually Gary Kasparov was the undisputed champion. This was, over 20-some years ago. But during this time, he was once asked why he and Anatoly Karpov were the two best chess players in the world. And his answer was astonishingly simple and direct. We attack better than anybody else, and we defend better than anybody else. Yeah, right. We're the best at what we do. And these people in the world of finance and investments bought the best companies, and more importantly, in my humble opinion, they avoided the worst companies. You understand? Sports analogies are not always great, but in my humble opinion, I'm far more interested in defense than I am in offense, right? And if you talk to the sports people, they'll say, offense wins the games, defense wins the championships, right? So if it works for you, great. If it doesn't, don't worry about it. Slide 51. Speaking of avoidance, as a mutual fund investor, which I mostly am, right, I am not looking to find the next Peter Lynch, right? I'm looking to avoid the next Charles Stedman. And look Mr. Stedman up. He's an interesting historical figure. He ran his own mutual fund, the Stedman American Industry Fund. That's a bad sign. You name it after yourself, right? From December 59 until his death in late 1997. And his cumulative total return over the largest expansion of the global economy in the history of the world was negative 42.9%. Yeah, he would have done much better simply placing his investors' funds into a savings account at a bank. He would have done better if he put it under a mattress. Well, who knows? Maybe he came from the life insurance industry. So you see, yeah, you want to find the best, but you also want to avoid the worst. Slide 52. Now here's some fabulous advice from our all-stars. Be fearful when others are greedy. Be greedy when others are fearful. And do you understand? We've made mention to this. We see a whole bunch of people running one way. What do? We're humans. We run with them. And that was great 100,000 years ago, because the people who didn't run were the ones who got eaten by the tiger. But now in the world of finance, you do that, you're going to get slaughtered. Yes. So he says, be fearful when others are greedy. When everybody's saying, oh boy, is it too late to get in? Yeah. And then be greedy when everybody else is scared to death. Oh no, is it too late to get out? Yeah. And his mentor, Benjamin Graham, said it this way. Buy when most people, including experts, are overly pessimistic, and sell when they are actively optimistic. It's basically the same idea. And John Templeton also says it basically the same way on slide 53. Bear markets are born of pessimism, grow on skepticism, mature in optimism, and die on euphoria. The time of maximum pessimism is the best time to buy. On a similar note, he also said to buy when others are despondently selling and sell when others are avidly buying requires the greatest fortitude and pays the greatest reward. Yeah, everybody else is selling. Everybody is running for the hills. You're going to get in there and buy? Everybody else is making huge amounts of money. Oh my goodness, you're going to sell? Well, that's history tells us that's how we do it, folks. If you're going to get in there and joust and buy and sell and be a trader. For those of us who are buy and hold type of people, we just keep putting $50, $100 every month into our mutual funds. And we don't worry about the best time to buy, the best time to sell. Well, every once in a while we might say, hey, it's a really good time, let's put some more in. But did Sir John Templeton follow his own advice? Oh, yes, he did, dear students. It's December 1941. Do you remember, you history buffs? The younger folks, they're not into history. I don't understand. I love history. Read historical novels. Read nonfiction. Also, history. Well, it's December 1941. That's Pearl Harbor, and the United States was finally kicked into World War II. And what is John Templeton? He wasn't knighted yet. What does he do? He tells his broker to buy every bankrupt company on the New York Stock Exchange. Here is the free world looking at the abyss and authoritarianism ready to basically take over the world. And this Yahoo says buy every bankrupt company in the New York Stock Exchange. 4 years later, the war is over, and Mr. Templeton is a very wealthy man. Would you have the fortitude to do that? I don't know that I would. Slide 54. Famous myths and stupid sayings. You're going to hear people say things that this is a lot from Mr. Lynch in his book, One Up on Wall Street. It can't go any lower. Oh, yes, it can. Once it hits zero, then it can't go any lower. But until it hits zero, it can go lower. It can't go any higher. Oh, yes, it can. If the earnings are continuing to grow, there's no limit to how high the stock price can go. If the future earnings potential of the stock of the company are great, the stock's going to go with it. It's only $3 a share. What can I lose? $3. It's $1 a share. The 25 cents doesn't matter how low the price is. The price can go to zero and you can lose all your money. Price is irrelevant. Valuation, the market capitalization, so to speak, is the key. Once it goes to zero, then it can't go any lower. They can't come after you after that. It has to come back. It has to come back. You ever heard of Penn Central? There's still a station in New York called Penn Station, but Penn Central was the largest railroad, had been around for over 150 years, and at the time, 1969 was it? It was the largest bankruptcy. How about Kodak or Sears? Right, they're not coming back, folks. When it rebounds to $10, I'll sell. Now, I understand how this works. Many people refuse to acknowledge we've made a mistake. It's human nature. So we bought it at $10. It's now at $6 or $3 or whatever, and we're going to wait for it to come to $10 so that we can sell and say we didn't take a loss. Well, the problem is if you wouldn't buy it now at $6 or $3 or whatever it's selling at, it's time to sell. Yeah, take the loss. You see, we're humans. We're wired in a certain way. If you sell it now, you'll quickly forget your mistake. But if you stubbornly hang on to it, every time you go look at your portfolio on the screen, you're going to be reminded of how stupid you were. So sell it and move on. The stock has gone up, I must be a genius. Or the market's gone up, I must be a genius. The market's gone down, I must be an idiot. My stock I bought was gone down, I must be. No, it's not true, folks. There's a saying, never mistake a bull market for brains. And it turns out the people who start at the beginning of a bull market often will be fooled. After a few years, they think, hey, I got this wired, everything's easy. Until a bear market comes along, recession, whatever, people just panic, And then they learn that, oh, yeah. So the stock doesn't know who you are, doesn't know you own it. The company's prospects are what's important. It's taking too long. Well, this is true. It takes a long time. Unless you're going to get in there and buy and sell and do aggressive growth. And all I can say is good luck, folks. Because it's not easy to do. Everybody I know who's tried to do it has done really poorly. But that doesn't mean there aren't people who do it well. But I like to use, again, another sports analogy. Have you ever seen a fastball go by at 95 miles an hour? Yeah, from afar on the television, or maybe you went to the ballpark. But when you're standing in that box and that ball comes by you at 95 miles an hour, right? And if you can get a hit 3 times out of 10, you're going to make a lot of money. And that's the same thing's true. Once you enter the world where you're buying and selling and trying to predict what's going to happen in the future in the short term, good luck, because the history says that there's really no rhyme nor reason. And then emotions are going to take over. So that's often the worst enemy, when you start panicking and the emotions take over. As Mr. Buffett says, investing is simple, but it ain't easy. So it's going to take a long time. Besides, if it's taking a long time, that's a good thing. You have a chance to buy more at a lower price before it goes up. Think about that. Slide 56. It's different this time. Whenever you hear this, it's a new era. It's a permanent trend. Whenever you start hearing these things, oh yeah, prices are high. We're heading for a fall. When people start saying these, I love them. What permanent trend? That's an oxymoron, folks. What does that mean? Like jumbo shrimp or straight curve. There ain't no such thing as a permanent trend. That's why it's a trend. It's not permanent. Markets move in cycles, and as we saw, I hope you took a look, or not, maybe you haven't looked yet, but you'll look at the results over the long term for stocks and the mutual funds that we have in Canvas and on the website. You'll see that there are going to be times when you're going to lose money. Sometimes you're going to lose a lot of money. And if the world does fail and there's no food at the Vons, no gas at the Chevron station, no close at the Gap, the cell phones aren't working, the utility companies aren't pumping out gas and electricity, the schools, the hospitals, the banks, the police departments, the fire departments are all shuttered. Your stock portfolio, your mutual funds are going to be the last thing you're worried about. You'll be digging beetle grubs for dinner, boiling bark. So I'm very optimistic. I've said this in the past. I'll say it again. Assuming we don't blow ourselves up and die in our own waste, earthquake, tsunami, Ebola, meteorite, disco returns. I'm very optimistic about the next 20, 30 years. More and more people, as a percentage of the world's population, are coming out of poverty. And that's a good thing. That's a great thing. Because they have more money in their pockets. They now can afford the things that we take for granted. Plus, that means more toothpaste and more yogurt and more cell phones and more shoes. So for investors, this is a good thing. And lastly, you're going to hear people say stocks are too risky. And you have to acknowledge, you have to acknowledge that there is a lot of risk involved. You have to say, yes, you're right. But even with all the shenanigans, even with all the stupidity, they're still the best financial long-term investment. And we have to believe that the system that we have, capitalism, which, may be the worst system ever devised for meeting the needs of your population, the goods and services that we need to stay alive, it might be the worst system ever devised, except for all the others. Slide 57. How about a career? Folks, think about it. Think about it. The financial industry is huge, and they need more people, because a lot of old folks like me are either going to retire soon or we're going to kick the bucket. And they need more women. They want more minorities. They want bilingual. They love ex-military. Why? Because it's a very structured industry, lots of regulation, and who better than people who lived in a very structured hierarchical society system such as the military. There are many different positions in insurance and banking and real estate finance, but in the brokerage world, many people will aspire to be a registered representative, which is the legal term for a stockbroker. I like financial representative, account executive, financial planner. I don't know. But they're going to do a background check. They want to make sure that you have done no shenanigans with other people's money. There are a couple of tests you have to take. The Series 7 is very hard, folks. I'm not going to sugarcoat it, but it's not impossible. It takes about 2 months of studying, 1 to 2 hours a day, right? It's a 6-hour exam. 3 hours in the morning, you get an hour for lunch, and then 3 hours in the afternoon. And you got to study for it. But most people pass it on their second attempt if they didn't pass it on their first attempt. Why? Because people have a tendency to just say, don't worry about this part, don't worry about that part. But internally in the test, there's about 7 different parts, and you have to pass each part with, I think, 70 or 72%. So you can't blow off a few of the parts, which are some of the parts. You'll learn more about this if you take Business 123, which you should do if you're interested in being in the industry. There's a few things like options, which are kind of tricky, and then there's shorting and buying on margin, which are pretty tricky, but they're not impossible. Most people who figure them out and they will help, contact me. I'll be happy to help you. And because of this, the Financial Industry Regulatory Authority has created another exam that you take before you take the Series 7. To get you basically ready for the Series 7. Plus, you don't have to be sponsored. Whereas with the Series 7, you have to be sponsored by a brokerage firm. And the firm is not really wanting to sponsor you until they know you're going to pass the darn exam. Because it's a bit of a catch-22. So the Financial Industry Regulatory Authority, we call them FINRA, has devised this new exam that is similar to the Series 7, but not as tough, but it's the same materials, the stuff we teach in Business 123, Introduction to Investments. And if you pass this exam, dear students, I guarantee the people will come a-calling. They'll want you because they need new folks. They know it. They need diversity. I don't know, forget the political climate. If you're a brokerage firm in the South Bay of San Diego and you don't have somebody who can speak Spanish, you're losing business. It's that simple. If you're an insurance company out in East County and you don't have somebody who can speak Arabic, you're losing business. And so the companies, they understand that the world is global. They understand that they need diversity. Forget for all the hype and all the America First stuff. America is diversity. I mean, we're California. You can't get much more diverse than California. Yeah, that's for sure. Okay, so let's now finish up on slide 58. Well, we actually got 2 more slides. And this is where we, in the face-to-face class, swap some more stories. Anybody want to swap some more stories? You see, as I said, the stocks that you buy and then turn out to not do so well, you'll forget about. So what do? I bring them back here on slide 58. And all of these companies started off well for me. I bought them and they started really well. And then things didn't go as planned. See, you've never heard of these companies, though. You understand? These were the small companies that Peter Lynch talks about and says, look, you're going to buy he calls them the stalwarts, the blue chip companies, the companies that have their roots deep in the economy. Yeah, you're going to buy those. But if you really want to make money, you have to identify, in the short term, you have to identify those small companies that could have the potential to grow very large. And each and every one of these had the potential to grow very large, but didn't for various reasons, some of which not of their own fault, except for this. This is the one that broke my heart. CNR Films. Look them up. This was my Peter Lynch stock. Buy what you know. My son was in 3rd grade, and we would watch the television together. PBS. We had it tuned to PBS. That was it. And for 20 years, the most popular kids show on PBS was Sesame Street, which is run by a non-profit organization, the Children's Television Workshop. I think they changed their name to Sesame Street. Along comes this film, this show called Arthur, and now it's the most popular PBS kids show. And Arthur is created by a company called CNR. And CNR is based in Montreal, and they're very creative, and they're pretty darn sharp. They made another show called Whimsy's House, and then one called Caillou, and they made this little distribution agreement with this tiny little electronics company based in Japan. You might have heard of them, Sony, yeah. This was in the 1990s. And so I did my research and I bought CNR, and things were looking good. They were doing well, and all of a sudden one Sunday, the Royal Canadian Mounted Police, which is the FBI up in Canada, swoops into CNR's office. And what was CNR doing? Well, in Canada's they're a little sensitive about their culture because they're overshadowed, and their economy, by the United States. So in Canada, if you hire Canadian actors and Canadian graphic artists and Canadian musicians and voice artists, you get a tax break. What was CNR doing? They were hiring Americans and saying they were Canadians. Okay, so pay a fine, get it over with, go on with the oh no. A few weeks later, it was determined that $122 million had been spirited away out of CNR's coffers, and the company just disappeared. Arthur's still around, but it's now run by another Canadian firm. And it's not exactly the same thing, but the same kind of things happen to these small companies. Alliance Pharmaceuticals, Advanced Tissue. Advanced Tissue was such an awesome company. They make tissue. They make artificial tissue because we've talked about diabetes before, folks. You don't want diabetes. In the latter stages of diabetes, your skin starts sloughing off, and it's not a pleasant situation. And that's what Advanced Tissue was working on, and they were doing really well, and then all of a sudden they ran out of money, and yeah, so oh well. So check these out and look at what happened to these war stories. All of them did well to begin with. I just picked the losers there, folks. But my investments in large companies and mutual funds that have been around for decades and done well in good and bad times, they've done well. You know, they didn't fall into pools of tears. So our last slide. What's the bottom line? What's the bottom line? Stocks are the best long-term financial investment available, but leave the stock picking to the pros. In other words, find a good stock mutual fund, which is the next chapter. We'll talk about mutual funds. And as bullish as I might appear to be, and I am, because I do believe in I'm optimistic about the future, especially with the younger crowd, and the technologies that are available to them. I mean, look at a company like SpaceX, which you can't invest in. It's private. But 10, 12 years ago, if you had told somebody in the rocket industry that you were going to take a rocket and land it back on the Earth and then use it again, they would have laughed. They would have just laughed at you and said, boy, you don't know what you're doing. And here comes along a guy named Elon Musk, and he hires not all, but mostly all young people. You look at the videos, and they're also all young people, and he tells them, your job is to land a rocket back on the Earth and reuse it. And sure enough, here we are. So I'm optimistic. But I pick a little bit of stock picking, but 99% of our stock investments are through high quality mutual funds. Because I believe it is simply unrealistic to think that I'm going to do better than professionals armed with an entire global research organization at their disposal. So I used to call it my Vegas fund. When I bought individual stocks, I tended to buy very small, very risky stocks that had the potential to explode, right, and do really, really well. And I called it my Vegas fund, and it lived down to its name. Then I changed the name to the Benjamin Graham Fund, and it did much better because I invested in companies that Benjamin Graham and Warren Buffett would approve of. So, what's the bottom line? The vast majority of us are going to buy high-quality stock mutual funds that have been around for decades and seen good times and bad times. But if you really do, if you catch the bug, if you think, no, I could do this, I can differentiate and identify good long-term stock investments, then please don't let me stop you. Plus, think seriously. Consider seriously taking Business 123, Introduction to Investments, and remember it's all available for free on the website, but you don't get college credit. Because in our next chapter, we will now finally dig deeply into the world of mutual funds, which are the investments for the masses. So see you in our next chapter, dear students. Thank you so much for being in our class. Thank you so much for sticking it out this far. We are so proud of you. We are so happy and privileged that you are with us. Keep up the great work.